Let's go. Good morning, currency traders. Forex, 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 Forex. So today we got to look at the euro pairs, the Swissy pairs, the pound pairs, the dollar pairs, the yen pairs. We'll look at gold. We'll look at oil. We'll talk technical analysis. We'll talk fundamental analysis. And let's go. So good morning. Welcome to the Forex.Today YouTube channel. Let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. G'day, mate! Hey, nice to meet you. My name is Wayne. I'm a currency trader just like you. I started a few years before you, so I learned through a few things through formal training and informal training, mostly by sitting here in my chair for blood, sweat, and tears for years. So I'm here to share the good, the bad, and the ugly, and the beautiful of all that trading experience, with the overriding goal of helping to teach you how to plan ahead using both technical and fundamental analysis to create trade plans and strategies that hopefully will protect you from the downside and reward you with a handsome upside. Risk, reward, profit, happiness, all of that stuff. A Trader's Way wants me to bring that into your life. Now, why would a broker want you to be profitable? Through having better skills and things like patience and discipline. Well, it's better for their business model if you come in, make a deposit at tradersway.com and trade day after 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 week after week after week after week after month after month after month after month after year after year after year after year. It's just a better business model. So it's really a symbiotic relationship between the broker and the trader, right? So Trader's Way wants to start the relationship off. In a sense, they're investing into your success now, today, hopefully earning your loyalty and respect. And then you'll pay that back by visiting tradersway.com, opening up an account, downloading MT4, checking out the execution speed that Traders Way offers you, check out the spread. If you don't like spreads, Traders Way can give you the option to have an ECN account. Super easy. Check out the amazing swaps. World-class customer service. Tradersway.com. Give them a chance, huh? Yes, and if I may ask, if these daily webinars and live streams are important to you, would you please tell YouTube? The way that you tell YouTube this is quality content is that you like, you subscribe, and you leave comments. And then YouTube says, oh, this is good stuff. Okay? So if that's how you feel, would you please take a moment and do so. Click the like, thumbs up type thingy-bobby. Much appreciated. Thank you very much. Trying to adjust the graphics. They're a little off, aren't they? It's too much. You probably can't even see what I'm doing. All right, we'll leave it at that for now. Something's off, though. Hang on. It's not perfect. All right, whatever. So, thank you for being here today. Thank you for being in my life. So let's do this. Please ask questions. Please get involved, and I'll do my best to answer. Some people recently have gotten upset that I didn't answer their question, even though they asked it 3 times. There typically is a couple of hundred people asking questions, so I don't even see every question. So if I don't get to yours today, come tomorrow and ask again. Okay? Cool. All right. So, yeah, boy. Let's see. I want to get this just over. Okay, better. All right. So, great. So we got FOMC today. They're not going to cut. Powell's going to have his press conference, and he's probably not going to say anything. And then for big money, that's important because it doesn't really set up a new trade, right? So one of the things we talked about, 6, 7, 8, 9 months ago. Oh, wow. Having the weirdest things. My platform just expanded into my other monitor. Hang on. Why did it do that? So anyways, tomorrow is the big day, really, because months and 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 months ago, I said the 12th of December is really the beginning of the end of the year. Right? So it would be really interesting to see what happens. 2 years ago, it was the 16th of December that yen pairs and Swissy pairs got ripper strong. So I wonder if that'll happen. Luis says, let's do some exotic swing, how to rebuild a carry trade portfolio. Wrong time of year for doing that, my friend. Okay. This is risk off right now, not risk on, my friend. So you got it backwards, Luis. So anyways, let's just go through and see if anything's going on. Really, we should be neutral going into this meeting. And then over the course of the next week or so, maybe see more of a risk off. And by risk off, it's really just profit taking. And we'll see if we get some Swissy strength and yen strength. Okay? It's just an idea. It doesn't mean it will happen. But when you have the idea, you can create trade planning around it. Cool. So, looking at this CAD Swissy, over the shorter medium term, there's slight bearishness. Would you agree with that? The top of this market was November 29th. Okay? Now, do you remember I said a bajillion years ago, bajillion months ago, that the Thanksgiving holiday could be a time when markets reverse? Well, that's this period here. It's interesting. Doesn't mean it's right, doesn't mean I'm right, but it's just interesting that that kind of price action occurred, right? And the reason it's interesting is even if it's unrelated to anything I told you about, I'm still going to believe it, right? Do you understand? So I don't know if it means anything, but I'm going to believe it means something because that's what I was looking for. So it's sort of that self-fulfilling prophecy. So there's sort of the top of the market. Okay. And then it followed up by a lower high. And we're supposed to be heading to this area down here. Okay. A standard deviation from the mean. Okay. And as you can see here, this is the mean. So if I were me and I was a bear on this, I would want this to stay below the mean, right? And so therefore, what I'm looking at now on a smaller time frame is, right, lower low, lower high, sell, there's the sell zone. Lower low, lower high, sell, there's the sell zone. Lower low, lower high, and this is today's sell zone. So I would be, inclined to do this again, right? So let's redo that last one as today's trade plan. So let's make this black. So if I were me, I would probably be thinking something like this. Okay? In effect, the target, let me redo that again. The actual target for today, remember today's day trade is based off yesterday's price action. And therefore, you can see here it says profit zone. Profit taking. Okay, Mpuku, profit taking. I've explained it before as wash sale profit taking in December and capital gains or tax deferral profit taking in January. Okay, so now I zoom in a little closer and I need to be looking, if I believe all that nonsense, remember it's just technical analysis, then I need to get short in this zone here, right? So we can translate that somewhere around 74.50 I want to be short. Oh, that's where we are now. So I could drop into something even smaller than a 15-minute. I can drop into a 5-minute chart, for example, and look for reasons to sell. Now we're zoomed into this channel, right? We have this. We have this. So let me try to redo this. It's pretty sloppy. And we have this. So if we're going to change direction here, we have to kick off this. Boy, I'm used to all these angles. Okay? You see that? That's the higher time frame. Remember, with fractal geometry, you're trying to combine the time frames, right? So what we probably need to see today, if that higher time frame plan is going to work, is something like this. Now with FOMC, we're probably not going to have the volume and volatility of a normal day, so maybe we don't get that today, but that's still the technical analysis. What do you think? Talk to me, Goose. What do you think? Any thoughts, any feedback, any comments? What just happened? No wonder this is all messed up. What the heck? All right, don't touch that wing. You guys are either quiet today or there's a massive lag. There shouldn't be. Maybe my chat's not updating. What's going on? No comments? None. All right. Well, then I'll go faster on the other ones. Okay, delete this out. Pound Swissy. This one is behaving differently. This is the end of November, right? So I was short this, and then, oh, it went even higher, which is fine because it's really, strategies are educated guesses. Then you get the lower low, lower high, sell, lower low, lower high, and we're approaching a new sell. And the next couple of days you'd be planning for this if you're a bear into the bottom of the channel. Okay. Next. Swissy. Okay. Again, November kind of 29th there. So this was I was hoping would be a top. That one did not work. There's the overall trend that we're in now, which is fine. Made a little higher. Great. This is right. Stepping up. Didn't step up. Lower low, lower high, sell. Lower low, lower high, sell. And turn this around. Okay. So this is today's sell zone. You should be on a 5-minute preparing to drop this like it's hot. I'll give you an example of that. Let's go from a 1 hour to a 5-minute. Okay. Very, very, very steep angle, but we're on the lower side of the standard deviation of the mean. And here's today's sell zone around 64.50, which is where we are now. So in a small time frame, you might look for a 21.55 cross. You might look for a lower low, lower high, and then sell. You might look for a double top and then lower low, lower high, sell. Whatever, it doesn't matter. Look for your reversal pattern. Whatever you like, look for that and set that up. Okay? So there we go. Let's do it this way. Down to the 55, back up, double top, down, up, down. Okay? Of course, if that happened, you would see the 55 flatten out. And if that happened, you would see the 21 flatten out. And that's your 21.55 cross. Okay, Ozzy. Ozzy's on a comeback today. Okay, now on this hourly chart, this is a lot different than what we saw in the other pairs. So we recognize right away, this is not the same price action. So here we are, the 29th of November, but do you remember all the other pairs were like this and either came down or went higher? But we never saw going into this with the other pairs sideways action into the end of November, right? We didn't see that. This is very unique. This is different. And you should recognize that or pay the penalty, of course. Okay? Lower low, lower high. This is a sell zone. Okay? This breach, once again, a sell zone, but now it's here. Okay? And then another day, lower low, lower high, sell. Lower low, lower high, and it went right through the sell zone. And we're actually at tomorrow's sell zone now. So there might just be something going on a higher time frame, because these are all day trades I'm showing you. So there might be a weekly trade that's set up here, but nonetheless, if you were a bear, there's your resistance, there's your roll reversal, and your higher time frame trade would probably be lower low, lower high, lower low. And as you can see, we're playing off this trend here. Okay, and here's the mean to those deviations. Okay, so on a smaller time frame, you would look for evidence of this rolling over to the downside, and because of where we are, you'd be confident to stay short all tomorrow. Okay, With that being said, you're going to face some FOMC risk. So if you feel like that's too aggressive, then don't do it. Wait, right? Because remember, you're supposed to be waiting for market conditions for your bias to fulfill your bias. Okay? You understand that? You don't trade every day. You don't have to trade every day. You're only supposed to make money. So if you're a bear and you see non-bearish market conditions, then don't trade. Okay? Mr. Highfield said, Wayne, would you reduce exposure on pound pairs before the election tomorrow? Yeah, address it any way you want, Mr. Highfield, right? So every situation is slightly different. If you have small profits, I don't know, are they statistically important to your year? Right? If you broke even on them all, would it matter? Or if you had 20 trades open with 30 pips each, you're like, well, might as well take profit, right? Or if you have 5 trades open but 300 pips each, you might say, well, this is going my way and it seems to be going my way and I think it'll go my way. And of course, you don't have any losses, right? Because that wouldn't make any sense. So I don't have a straight up answer, but the way you handle it, Mr. High Volt, is the key is recognizing that the risk is apparent, right? You apparently have this risk coming up. And then you look at it and you make decisions. Most people don't even see it. Like they don't even get it, right? So the fact that you get it, now you have to say, well, I really have to think about this, right? So I don't know how many trades, how much profit, where did you enter, why did you enter, what was the plan? So like for example, I showed you a whole bunch of trades and I said, I don't want 25 pips profit on these trades. I want 1,000 pips profit each on these trades. So in that case, if I was going into a British election and I had some trades open, they had 25 to 50 pips each, yeah, I guess I'd jam my stop at break even or not even at break even. But I would only manage the risk. I'd say, look, if this goes to crap because of volatility around the election, I'm not going to lose a lot of money. That's the first thing, right? That's the number one thing I'm concerned about all the time. If this goes to crap because of an election, because of an announcement of an election, because of an outcome of an election, because of the perceived outcome of an election, because of a tweet, right? I'm not going to lose a lot of money. That is the number one thing. Then after that, I'm like, okay, if I bust out break even, does it matter? Right? Does it matter? No, it doesn't matter. You're in some good trades. You got the opportunity. Okay? So if you took profit on 4 trades that are worth 25 to 50 pips each, let's say it all averages out, you get like about 100 pips. Dude, that's a mediocre trade on an average day, right? So you're like, yeah, you don't really need that. Because you might be set up technically beautifully, right? Your trades might be technically beautiful. And then you got this whole fundamental thing. You're like, I'm positioned on these pound trades so that if the election has the outcome I anticipate, I would then anticipate the pound doing this, appreciating or depreciating. And you're like, but I'm already in those trades. And of course I'm talking as you would say, I think I'm right and I'm in beautifully. This is all part of my plan. Now you're thinking 300, 400, 500 pips per trade, not 25 to 50. You see what I mean? So then and then would that statistically be important to your performance for 2019, right? 5 break-even trades or 5 trades with 200 or 300 or 400 pips each. Yeah, I'd rather take the 2,000 pips, but a bunch of break-even don't hurt me none. No one even sees it. No one even cares. That's why I love to take those as like -3, because they're like, man, you got a lot of trades that are like -3, -4, -8. Like, yeah, it's because I manage my risk. I get into lots of opportunities, and many of them don't work out, but the ones that do are home runs, triple bases. Right? You can win a lot of baseball games when your players get on second base a lot. Okay? So it's just like that. It's not that I'm going for home runs. I have like more of a strategy behind it, right? So that's I guess is where I'm going, right? Does that make sense? I know it's not a defined answer, but there isn't a definitive answer to this type of thing, except whatever you do in regards to any risk management plan is always ensure that there's no way, no matter what happens, that you're going to lose a lot of money. Okay? You have to understand, no scenario where you lose lots of money. Okay? That can never happen. If you're in 3 trades that are all losing, don't add a 4th one. In fact, right? Like, wait. You got tomorrow, and the next day, and the next day, and the next day, and the next day. Why are you so aggressive? You got no winning trades and you want to add another one? No. Yeah, but that wasn't a risk management issue, okay? That wasn't a risk management issue. I'm saying in regards to your risk management, like some people will have 3 losing trades on, right? -22, -33, -11. And they're like, yeah, I'm going to add another one. You're like, why? Your first 3 haven't even produced anything yet. Why would you add another, right? Well, no, but I said never based on your risk management, okay? But yes, there's been like 3 times in 15 years where something undue occurred. Right? But very few things have been dramatically surprising. In my 15 years or whatever of doing this, very few things have been dramatically surprising. But yes, the Swiss National Bank one was. Okay. All right. Nothing's random, Leonardo. There's nothing random. Okay. All right. All right. So, how do we play this? If you're a bear, well, I guess we can just go into what we were doing before. Let's take a look at day trades and see if anything show up. Okay. Right now, like we did on the other pairs, just to keep it the same, this is the end of November, which I was looking for some down. I got it for a while. Then it popped a little higher for a couple of days. Remember, I'm planning 6 months in advance, so to be off a couple of days is not that crazy. But anyways, so there was a step up, right? A step up. Step down, okay? There's your sell. Come on, pink. There we go. There's your sell, right? Step down. There's your sell. So we'll see, okay? This is a big move, but look how accurate the sell zone is. So, is this random, guys? Okay, it's not random, is it? So check this out. If you were using nothing but price action, you would look at this price level here and you would use that as your role reversal. Okay? So really, this is combining today and tomorrow together. Okay? So it's risky with FOMC, but that's what the technical analysis is trying to do, right? Down, 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 up, up, sell. Down, 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 down for today and tomorrow, right? Rizwan, I developed this yesterday, actually the day before yesterday. So I'm still pulling it together for you guys. It'll be part of metatraders.com. Probably a New Year's gift or a Christmas gift to all the subscribers or members of metatraders.com. Every tool here is already on MetaTraders. The only thing new is I've customized, I created a new pivot point plotter. Okay. But it's the same concept as any other pivot point. Actually, the major difference is it forces you to make the decision. See, I'm worried, like I'm always trying to help you become more successful, right? Let's go all the way back. The raison d'etre. I want you guys to be successful. And if you're already successful, I want you to be more successful. And many newer traders, they look to their indicators to make decisions. And it's instant failure. They're looking for the holy grail. They're looking for the green arrow, the blue arrow. Even if they're not saying that, they're like, no, wait, I want to learn technical analysis. I want to be a professional trader. Good. And then they say they're looking at their MACD, and then they're looking at their RSI, and they're looking at this other thing, and they're looking at this other thing, and they're looking at the technical analysis to tell them answers. That is not correct. Okay? That is not correct. The way you're supposed to trade, and make sure you write this down if you haven't heard this speech before, but the way you're supposed to trade is you make the decision. And then you use your tools, your technical analysis tools, to confirm market conditions for your decision and to confirm the timing of your trade entries, right? But the stuff on your chart doesn't tell you what to do. So if you are looking at your technical analysis to say, I should be a bull or a bear, you're not doing it correctly. Okay? So this version says, are you a bull or are you a bear? And what it really does is just delete all the stuff you really don't need. Now, it's not perfect right now. I have a meeting with the programmer again, I think later today, to make some more further adjustments here. But the key part that I wanted is you have to tell the charts your bias. Because you made the decision, not the pivot points. You don't say, oh, look at the central pivot. I think I'm supposed to sell here. No! So you have to make a decision and say, oh, well, for the Kiwi Swissy, I'm a bear. You know this, right? You guys know this. You guys know I'm a bear. Now, you might not understand why. You might not agree with me. All that kind of stuff. I might be totally wrong. None of that matters. But you know I'm a bear. So I go to my chart and I say, hey, charts, I'm a bear. Tell me where market support and resistance is. Now, the other thing that's on MetaTraders is I have this auto plotting channel indicator. So it's looking at short, medium, and longer term trends. So I'm like, you know what? I'll throw that in there on the day trading thing. That's cool, right? So these are just tools that are generally already available because, like, for example, you don't need these pivot points. You can have the regular pivot points. It tells you the same thing. It's the same calculations. Okay? That's all. But in this case, I can look at this chart and I'm a bear, right? So should I sell this when price is above the sell zone? No. Should I sell this when price is above the sell zone? No. Should I sell this when price is reversing at the sell zone? Heck yeah. Should I sell here when price is reversing at the sell zone? Heck yeah. Should I sell this when price is reversing at the sell zone? Heck yeah. What about tomorrow? What if it reverses here? Should I sell there? Heck yeah. But this is what you're supposed to be doing anyways. So I thought, well, maybe these tools, some of these might be helpful to somebody. Right? Some of these tools might be helpful to somebody. Maybe they won't be, the cool thing is it's only money. I hired someone, I gave them money, they did the programming for me, and they spit this tool out, and now I'm going to put it on metatraders.com. Cool, right? Cool. It's just nice. Maybe you like it, maybe you don't like it. You don't have to use it. It's just, right? So when I'm looking at this now, it's saying on this time frame, there was a channel. You see that? There's a higher one. So on this hourly trend, the trend has been up. But on a 15-minute chart is what it's doing. It's actually calculating this on a 15-minute chart. On the 15-minute chart, it's not going up. And then you see down here, there's even a smaller time frame. Now I got to do it in blue. There's even a smaller one. Here's the mean. Here's the standard deviation, right? So here's what I'm thinking, and this is what you might think. If you're already a bear anyways, so let's do this, and I guess I have to do it in a green. If you're a bear anyways, right? You're probably thinking something like that, right? Now, if you understand technical analysis well, you'll probably know over the course of next 2 weeks, even if it does that, right, there's a huge chance we double top before the actual drop. Okay? So I don't know if that would happen before the end of the year. If we went into the end of the year and it was bearish, this rally would occur in the 3rd week of January. By the way, just so you know that. Ed says, Wayne, do you remember G7 central bank intervention? Yes, I do. Now, if you're making that comment on my comment about, you'll never be in a situation to lose a lot of money, what I said is we were addressing risk management. So when you're managing your risk, your number one goal when managing your risk is to always ensure you're never facing the possibility of losing a lot of money, which means you don't have 9 losing trades open. You don't have trades that are negative 400 pips, right? You're never in situations like that. Because if you are, you're not managing your risk. So if you have 3 trades open, and they're not really big losers, but they're not winners either. Like I said, negative 33, negative 22, negative 11. Hey, before you add yet another trade, why don't you let those ones work out? You know what I mean? Well, James says, don't bet the farm. Well, that's even, I know I'm being simple, but that's even more simple, right? Like, who would do something so stupid, right? Nobody does that. Nobody. If you're going to have a chance in life, you don't do that. So that goes without saying, right? What do you mean bet the farm? That's like Russian roulette. It doesn't make any sense. If you don't have a fear of losing money, then you probably don't have any money. So that's more of a desperation play, right? Like if you were starving to death and I'm like, I'll give you $1 million on this Russian roulette game. You're like, look, I'm going to die anyways and I could use $1 million. So you take it, right? So I'm not talking that. But if you have 3 mediocre trades, do you add a 4th one? No, you don't deserve it. You should keep your powder dry and either, right? But your other trades they're not bad trades. They just haven't worked yet. And I'm assuming all your trades make sense. So like, for example, if I shorted Kiwi yen and Aussie yen and CAD yen, obviously I'm buying yen. And it looks like I'm selling some commodities too. Cool. But before I sell pound yen and euro yen, right? maybe I should let the first three work out first, right? Like, why add another one when the other ones are not even profitable yet? So I wouldn't add a fourth until, really, honestly, probably all three of the first three have to be profitable, right? And if all three are not profitable, I'm going to be sweating bullets. Now, if those numbers, you've probably only been in for a couple hours. So typically what I'll do is I'll place my trades and I'll move my stops so the risk isn't a lot. And I get it all tweaked and I get it all nice. And then I don't look at it again until tomorrow. And I come back and I'm like, did I bust out on those? And very often I just look at them like, no, they're good. And then I just move on to my new trades for the day. And it's almost irrelevant. Like if they all got knocked out, I'm like, oh, I guess I have to set up something new. Is it really bearish? And I look at the market. Yeah, I still think it's bearish. Why didn't it work out? Did I mismanage my stops? Were they too close? What was I afraid of? What's going on? What's the risk tomorrow? What's happening next week? And I try to figure out maybe why I was wrong, but not even why I was wrong. Like, was I wrong with the market conditions? And if I look at them like, well, market conditions still look bearish, then like I have to figure out why. Like it should be, you should be shocked, right? That you lost money. And you kind of have to figure it out. Like you sold 3 yen pairs yesterday and they all lost. Really? Why? Did you screw up the risk management or did you screw up measuring the market? Right? Like you should be inquisitive. You're like, how could I get that wrong? Good thing I didn't add 3 or 4 more trades, right? Like honestly, if you plan your trades based on fundamental and technical analysis, you should be scratching your head like, how did I lose money on that? Why didn't it work out? You're like, oh, that thing I missed. Oh, I see. I missed that thing. Oh, I was a little early or I was a little late or whatever. But like some of my mediocre trades I've been in for like 2 weeks now and I'm still not like losing money. Or if I'm losing money, it's hardly anything, right? But like, so you have to really ask, how could you be so wrong? Okay? You're allowed to lose money, but it should be a bit surprising. So for example, if I'm a bear here, my trade plan right now should be selling here to here. Somewhere in there's my resistance. I have that both technically based on price action, right? And technically based, right? So that's a price resistance. And then I have a market resistance. Okay, oops, so it should be black. There's my market resistance overlapping price resistance. And it's just a day trade. So it's not big time frames. So it should be fairly easy around the 64.50 area to spot a reversal, right? The next one would be way up here, but that's not supposed to happen today. So it doesn't involve me today. Now maybe FOMC jacks it up there, so maybe you set an alarm and say, well, maybe I should be alerted if we happen to be up there. So you can set an alarm, right? Okay, boom. If we get near 65, let me know. Send me an email. Cool, right on. So, but it shouldn't concern me today. Now I can change this and say, well, what about on a weekly time frame, right? Well, that's a whole different trade plan. Okay, on a weekly, what was the sell zone for the week? Can you see this, guys? Well, anyone who's taken the swing trading course will tell you, you should have sold this on Monday. Sunday afternoon, in fact. If you were a bear, it doesn't get any easier than that. Just as a swing trader, right? Now, it's a little aggressive because it's been going up, but bear in mind, I want to be a bear already. You see this? This is how you filter through all the noise and all the information. Okay? Here and here and here, I was already a bear. I have to look at this and say, are market conditions favorable? Do I have the right prices? There's reasons that you could have sold here and broke even. There are reasons where you could have sold here and made money. And here's another thing. A swing trader, when the market opened here, I keep trying to change the color. There we go. When the market opened here, a bearish swing trader would sell that. That's it. So that's already in play. Okay? The secondary play now is here. Right? Now, price action traders see this. They see the down, 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 up, up, sell at the roll reversal. Okay? They see that. Down, 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 down. Actually, there's more. I need to get on a smaller time frame with my price action. Let's try to do this again. Well, I'll leave that. Okay, this you do all day, every day. Let's do this ugly orange, I guess. I mean, there's lots of little moves, right? Down, 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 up, up, sell. 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 Down, 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 down. Okay? And then this is another higher time frame play where you got to go then, you know, this. Down, 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 up, up, sell. It's the same as the smaller ones. So you can think of this as maybe this ugly orange one is like price action on a 15-minute chart. And this more purplish one is price action on like a 4-hour chart. Right? They're both the same price action. That's part of the fractal geometry now. Right? Same price action's the same. The pattern is the same. All you're doing is you're changing the time frame, which means it's all relative to your time frame. So if you're a bear and you're looking for a lower low, lower high scenario to sell, okay, you will find that relative to the time frame you're observing. That's Einstein's theory of relativity. Depending on, right, where you're making your observation from. Is it a 4-hour chart? You'll find it. Is it a 1-hour chart? You'll find it. Is it a 15-minute chart? You'll find it. Is it a 5-minute chart? You'll find it. So that's why kind of overlapping these things is important. So if your technical trade plan today is part of this down, 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 up, up strategy, because it's a 4-hour kind of play, you know the price in which you might be interested. Okay? You know you might be interested around the 64.57 area. We're a little higher than that. So what? You have the roll reversal. Okay, is what we're looking at. It's not a pivot that we're looking at. We're looking at like a roll reversal. And you have that daily zone, which is part of your smaller time frame analysis. And it doesn't say sell. All of this says, since you're a bear, and you've analyzed the weekly chart and you've analyzed the daily chart, if you were to add yet another short trade, then on a 5-minute chart, let's say, or a 15-minute chart, strategy and tactics, on a 5-minute chart here, if you see a reversal pattern, that would give you permission to trade to the trade as a bear. Right now we're looking at this and we're like, okay, you want to be a bear, so what? Great, congratulations. Are these bearish market conditions on a 5-minute chart? No. Are we at a right price where you could consider maybe being a bear in here? Yeah, we have that based on price action, and which only tells us we're at resistance. And if you're a day trader, you're like, yeah, this is sort of a right area for measuring based on what happened yesterday in the market. This would be, in theory, based on that, a decent price level to sell. So you have this price action and you have market action saying, yeah, somewhere around here, if it turns bearish, go ahead and be, since you're already a bear, then the market conditions would be favorable for you to trade. You see that? But it doesn't tell you to trade. This doesn't say this will fall. This doesn't say you should be a bear. You're already a bear and you're using tools. This might be the right price. This might be the right time. You don't really know. So now you use your technical analysis to confirm or deny. So go back to the day trading bearish. You have permission. But is this ready to sell? No. We're in the right price area. But the time isn't correct. You got the right price. And price, by the way, is indicated by this stuff. Okay? But what you don't have is the time. Is this the right time to sell? No. Is it the right price to sell? Yes. So come up with a tactical entry. What is your tactical entry? Do you like 5-8 crosses? Do you like 2155 crosses? Do you like candlestick patterns? Do you like, I mean, what do you like? What do you look for? What do you do? What is it that you do? You understand? Look how easy this is. I just dropped the Kiwi Swissy market on demand. Isn't that great? You're welcome. Would you please click like? Would you please do the thumbs up if that was good? Tell me it was good. I want you to want me. I need you to need me. I'd love you to love me. Sub me, baby. Sub me. Thank you, guys. Smash the like button. Good. He's a good. Well, you guys are quiet today. I guess you're just like counting your stacks of gold. Cool. Forex Trading says, good, would like that indicator. Yeah, all right. Well, it'll go on MetaTrader, so everyone that is part of that service will get it. But the thing is, you already have all of this. You should have all this already. I'm imagining you paid $5 for the templates, right? So I'm imagining you paid the $5. So it'll be on its way. But the thing is, you already have pivot points. You already have channels, right? You can draw your own regression channels. Like, you already have all of this stuff, right? So don't, I only say that because I'm worried, like, what you don't want to do is to say, if I only had that, then I'd be successful. No. Okay, you already have all this, right? Mr. Heibel, I don't know if you, did you pay $5 and join MetaTraders? I don't know, Mr. Heibel, if you are or not. I mean, what would be the best set of common markets to judge economies and drive a bias? Yeah, well, any fundamental analysis, and that comes down to macroeconomics. So, like, I'd just say central banking policy. Oh, well, if you joined FX Bootcamp, no, you're not a member of MetaTraders. But balance of trade, Andrew, yeah, but like balance of trade when normal, and really what it is like Australia is really in a world of hurt and they have abnormal balance of trade. But let's say we go to a normal world. Exporting countries export more than they import. Importing countries import more than they export. And this will impact demand for the currency, right? So an exporting nation like Australia typically has a very, very strong currency. Okay? Why? We'll take China, for example. China likes to buy natural resources. Great. Why? Well, because it makes a lot of stuff. And to make stuff, you need raw input. Okay? All right. So China's been blessed with an abundance of natural resources, but often they can't get it fast enough. That's the issue with China. They have lots of everything, but often they just can't get enough of it fast enough. They can't, if they need coal, they can't get it out of the ground fast enough, right? So anyway, so in those situations, they have to look outside their borders and import. Now, we said typically for Australia, they export more than they import. Well, what is it that Australia exports? Australia, the two major exports from Australia are iron ore and coal. Now, if you happen to melt the iron ore into a liquid and then take some coal and sprinkle some just on top, you don't need much, it becomes steel. Oh, that's interesting. So when China needs steel, they need iron ore and coal. Great. So right? So what happens is Australia sends the iron ore coal to China, but what does China, right, send to Australia? Money. But wait, RMB is not accepted in Sydney, okay? So China has to go into the international market, the interbanking system, convert currency into Australia dollars. What does that mean? They actually have to buy Australian dollar. Billions and billions of Australian dollars just for one trade deal, right? So China gets iron ore and coal, and Australia gets money, which pushes up demand for Australian dollars, right? And now the Australian dollar goes up in value because foreigners are buying it. Well, what they're actually buying is they're buying Australian dollars, so that's the first asset they buy. And the second thing they do is then they convert the asset, money, into the commodity, iron ore and coal. Then they take the iron ore and coal and they put it into like a hopper car type boat, right? They put it in a boat and they ship it back. So in times when there's lots of economic activity around the world, like it is normally, countries are buying stuff from China. Chinese factories are working night and day to produce these things. Because of that, there's so much demand for raw material, China can't get their own stuff fast enough. Because China has blessed with many natural resources. Wonderful country. But they're producing so fast, they're like, it's not enough. So they go to the international market and they need to buy this raw material. So they need to convert their currency by buying other currencies around the world, Brazilian real, for example, so that they can then convert the real, or real, if you will. You can convert the real into soybeans and bring the soybeans home. Or you can buy Australian dollars and bring the iron ore and coal home. Or you can turn it into euros and bring Chateau Lafite home, right? Or buy Canadian dollars, which then you convert into oil and you bring that home. So that pushes up prices for commodities, that pushes up exporting nation currencies. But if you're the importer, like the United States is importing, TVs from South Korea and phones from China, when that happens, they're flooding the market with American dollars because they use their American money to, let's say, buy, we'll take South Korea. They get rid of American money, they buy South Korean money, and then with the South Korean money, they buy LG TVs, right? And bring that home. So in a normal market, when the market's functioning well, countries like America have a weak currency. People are like, that doesn't make sense. Why would the currency be weak? Because they're buying so much stuff from around the world, they're flooding the market with dollars in exchange of getting TVs and cars and Bart Simpson t-shirts, okay? And $200 yoga pants, okay? You understand? So much of this, when we're talking about raw material, so we'll go back to the the China-Australia relationship. China goes to the international market, they buy up Australian dollars, driving up the value of the Australian dollar. Then they convert the Australian dollar into iron ore and coal, okay? Driving up the price of iron ore and coal. Then they got to put it in a boat, and they got to ship that home. Let's take a look at that. Baltic Dry Index. Boom. That's fine. I typically use Bloomberg, but it's been a while. Yep, Bloomberg. All right. Lip, lip, lip. You can track the price. Okay, this is an index. So let's go back. When economic activity is booming around the world, China's booming, Chinese factories are booming. They need, now Chinese manufacturers, to produce the products that they're going to, right, that are in demand, they need commodities. So China goes to, converts their currency, buys Australian dollars, and then with Australian dollars, they buy iron ore and coal. Now imagine every country in the world that's importing stuff is doing this, okay? If you buy soybeans from Brazil, you got to ship them home. So check this out. You can track the supply and demand of the ships. Okay, I'm taking this to the next level. When the economy globally is booming, you might not see this in retail sales yet or whatever normal index you use currently. But you can look at the price of the ship. If the Chinese importer then says, okay, we got 27,000 tons of iron ore from Australia and we need to ship it back to China. When there's lots of factories doing this, and it might not just be Chinese factories, just globally, demand for Australia coal, for example, has its ups and downs, its ebb and flow, right? Now, Australian coal, for example, is some of the cleanest coal in the world. It's fantastic coal. And if you know anything about coal, it's under a mountain. So when you go to like West Virginia or Kentucky, they cut the mountain in half and dig it out of the mountain. And then they leave the mountain there to die. In Australia, the mountains have worn away over millions of years. And so what you do is you just kind of sweep the dust away. And there it is. Look, diamonds. Oh, look at this. Coal. It's just right there. And then you pull it out and it's some of the best quality coal in the world. So if you need to make high quality steel, or if you want to burn it in an electrical plant but not produce so much pollution, you should probably use that wonderful, fabulous Australian coal. But this gets shipped around. You got to put it in a boat, okay? So if lots of people are buying stuff from Australia or Brazil, there's only so many ships. So the ship, you have to decide. The shipping company now says, well, should we bring soybeans home from Brazil for customer A? Or should we bring coal home for customer B? Who should we go with? So what happens now? How does the shipping company make a decision? There's only one ship, and this is a short run. See, in the long run, you just add more ships. But how long does it take to make one of these super tankers? It takes years. So in the short run, the shipping company has to choose customer A, customer B. How does that shipping company make the decision, y'all? They jack up the prices until one guy says, you know what, that's too expensive for me. And the person willing to pay the highest price wins, right? So now you can track the rates. If prices are going up because demand for the shipping containers, because remember, supply is fixed. There's only this many ships today. And that's that. You can't just add more, okay? So the supply is fixed, demand shifts up and down. So if demand is shifting to the right, prices are rising. And if that's happening, economic activity globally is booming. Isn't this cool? So now you can take a look at these. And the site is just terrible now, right? But anyways. Look at this. Prices are up 20% year to date. 52-week range. Come on. The site's always like this, really slow. All right, so let's do 5 years. Come on now. Broadcasting always slows this down. I don't know why. I'm pushing a lot of data. Oh, they're trying to run an ad? Yeah, come on. There we go. Now I have to get rid of the ad. Get rid of the ad. And then the chart went away again. I saw it there for a second. Gee whiz, Bloomberg. There we go. All right. So in 2016, the index was reading 291. And the peak this year was almost 2,400. So we went basically from 300 to 2,500. So one thing you might be able to do it up. Yeah, that's what it looks like, Grand, right? But I'm pulling 1,000 megabits per second. So it must be a processor issue of me broadcasting and the amount of junk they have running on this site. It's probably full of JavaScript or something. So anyways, guys, one of the things you can do is maybe use this as a leading indicator and say your analysis of the Baltic Dry Index shows that economic activity has probably slowed since September 2019. Now imagine you were talking to a client and the client says, hey, so what do you think about 2020? Is the market going to continue going up or is it going to go down? And you say, well, I have a couple of concerns. First of all, I really don't know the outcome of the election. And as we get closer, we'll learn more and more. Okay? So that is a concern to me as a market analyst, as an economist. Politics really can impact market conditions. So I'm looking at that. But also, I'm a bit concerned about economic activity globally. And one of the things that I do is I track the prices, right? The supply and demand of shipping cargo ships. It's not actually cargo, it's hopper ships. So don't think of the ones with the train cars stacked on top, right? I'm not talking those ones. I'm talking specifically like things like iron ore and coal and soybeans, right? Demand for these types of raw material have declined pretty substantially since September and all the way steadily through the fourth quarter. And it may be seasonality, it may be the trade war, but it is something to be concerned of. Okay? And you can, all of a sudden you're talking like so intelligently. People are just amazed at what you know. Okay? Isn't that interesting? Now, I was teaching people this 12 years ago. Right? So if you're at FX Bootcamp, you knew this 12 years ago. But it's really interesting. Now, sure, it's really kind of academic. It doesn't put you into a trade and such. But it's part of the analysis that you can use. Now, there's also a website in America that tracks the demand of trains. Remember, there's only so many trains. But how much cargo needs to be shipped from ports on the coast to cities inland? How much demand is there? Remember, this is kind of an interesting thing, right? Because if there's no demand, there's no activity. If there's no activity, it's going to impact that local currency. Oh, the future says, is there any logic to the politics, right? Like, why would the market go up and down if such and such U.S. president comes and goes? Well, first of all, let's address that because it's a great question. Okay. The first thing the market wants is certainty. They don't care really about who becomes the president. Generally, the politics are not, let's say, radically economically different. They're politically different, right? So if there's a president and cabinet in place now and policies in place now, and when a cabinet and a president takes over, they make changes in policy and procedure and law and all this kind of stuff that, that the market can get used to, and then they can start planning. So if you're in finance and you're worried about, what is the cost of capital for your project over the next 7 years? Well, you need data like, what do you think interest rates are going to be in 2 years and 3 years and 5 years and such. And you use that in your financial analysis and risk analysis and in your assumptions and when making decisions, okay? It's just a normal thing. And so regardless of who's in the White House, if they've been in there a while and everything's established, you can say, oh, well, the policies and procedures, and you have a pretty good guess on where that White House is taking the general economy, right? And you've learned how to deal with it, and you've tweaked your assumptions, and where will interest rates be? Is the economy going up? Is it going down? All this kind of stuff, right? And you make your projections, best case, worst case, base case, all that kind of stuff. And you make your financial decisions. Should you build the factory? Should you buy the building? Should you hire more people? Okay? Then what? If a new president is elected and a new cabinet is hired, things might change. You don't know if they will change, but you just don't know. Is this good for the economy, bad for the economy? Are they gonna push things up, or are they gonna push things down? Will this change interest rates 5 years from now? We don't know. 4 years from now, what's the economy going to be like? Should I be building this factory? Should I be hiring people? What are my tax rates going to be? What's the discount rate going to be? What's the inflation level going to be? Well, different presidents and cabinets can influence, based on their political agendas, can influence the outcome of all these things, right? So if it's just new unknown, then that in of itself collapses the economy, at least in the short run. Well, all of this gets figured out. But by short run, I mean like 12 to 18 months. And then finally, the new president and new cabinet, they do what they are going to do. They announce what they want. They tell everyone the agenda. The market has some volatility while they adjust. And then finally, off you go, right? Now, some political agendas in which people run on, you can guess how that effect would be on economic conditions. So for example, if a candidate comes out and says, I'm pro-business, and if you elect me as president, I'm going to cut taxes on businesses, right? And I'm going to do whatever it takes to support the business, whatever. you could look at that and say, oh, this guy's pro-business. They're going to lower taxes on the businesses. They're going to lower capital gains taxes for investors. They're going to allow money to come in offshore for cheap for a while. All this stuff is going to spur economic activity, increase profitability of doing business in the United States, and really increase demand, expectations for higher future profits, which would then drive up the stock market. And especially if you threw in that piece that I mentioned where capital gains might be less, tax might be lowered by this candidate, then you're like, dude, if you make money in the stock market, taxes on that will even be lower. So now you're attracting investors into the stock market, and now you get IPOs, you get all-time high stock markets, new companies are being formed, and you can guess what that policy is. Or you can be the opposite and say businesses are evil. They're what's causing all these imbalances in our economy and in our society. And the reason some people are starving, and the reason that some people are rioting, and some people have so little, and some people have way too much. All of this is created by the evil businesses. And if you only elect me as president of the United States, I will fix this. I will get you your food and your medicine and your shelter. I will provide that to you as president of the United States by taking the excess from the greed and the sloth and the evil businesses, and I will transfer all this to you to take care of you, my people, that deserve better, that want back into the American dream, that want to live a decent life. And that person gets elected, and you're like, ooh, well, this could have different impacts on not just society, but on economics and investing and all this kind of stuff. And whoa. Okay? And you have to make your adjustments and plan. Do you want to build a project like let's say right now you're working in Elon Musk's office and he says to you, I want you to go to Reno, Nevada, and I want you to analyze the situation and tell me if we should build $100 billion battery plant. Well, we know they already did, but let's just say that decision was being made now. Okay? And then, so Elon says, well, what's the risk of this project? And they're like, well, Elizabeth Warren loves you, or Elizabeth Warren hates you, right? And I don't know if she's going to become president. Right? Like, I don't really know, So you have to then make models. Okay, if Trump wins, we expect this or this or this. If Warren wins, we expect this or this. If Biden wins, we expect this or this. Like Biden will get elected and nothing will change. All right? They'll bring Obamacare back or something. Great. Okay? But the market's not going to crash. Warren comes in, the market's going to crash. If Trump comes in, the market's going to rally. Now, does that mean I'm pro-Trump? Not necessarily. What it means is the market already knows what to expect from Trump. They're already used to his tweets and his tantrums and his wars, his trade wars and stuff. Everyone's used to that. We already have the models. We're already using the models. Think about it. Goldman Sachs is making money today. JP Morgan's making money today. They may not like the policies, but they know how to make money now. So if Trump wins again, they're like, game on. It's just the same shit. Let's just keep going. Keep making money. Warren comes in. They're like, whoa. We don't know what's going to happen here. She might come in and break up banks. She might tax the heck out of things. She might jack up or restrictions and regulations and lower our leverage, and all these things could have a dramatic impact on banking and in finance and investment. And oh my God, right? And Biden comes in, they're like, yeah, ain't nothing going to happen, right? So you have to be able to plan all of this. So, does it matter? Yes, it does matter. Because if I'm not mistaken, Trump was perceived as dollar bearish. Yeah, but that's a good thing. I keep trying to tell everybody this. Every day I probably mention this. When things are good in America, the dollar is weak. You want a weak dollar. If Americans have a weak dollar, they're filthy, stinking rich. Okay? So you got to get your head around that. For a lot of people, that seems backwards. Okay? But I've explained many times through behavioral finance, when it comes to the reserve currency, it's not true that when the economy is bad, the currency is bad. That's generally true for everybody, but not the reserve currency. Okay? So when every American is filthy, stinking rich, and they're wearing Vibiliqueen swim trunks for only $700, and they got a Samsung TV that's 82 inches, 8K, bro, 8K on the wall, right? They have a $140,000 BMW. Americans are filthy, stinking rich, but dollars were exchanged for euros. Dollars, what's South Korea? South Korean won? South Korean, SKW, right? KRW, right? South Korean won, right? They sent the money to South Korea and got the Samsung TV. The Vibiliqueen swim trunks, $700. That goes to France. So again, euros, right? It is one. Yeah, that's what I thought. I don't know why I was stuttering on that one. It's weird. I stuttered earlier too. I'm like, it's one, right? I guess I haven't done that KRW in a while. But anyways, you can see that, right? The money going out there because Americans are rich. Now think of it this way. Americans, in that scenario, their time is expensive. So it's just cheaper to pay other countries. That's why it's weaker. I could mow my own lawn. My yard, one person to just mow and blow would take 4 hours. But I pay a crew and they show up. And they have the equipment, and they maintain the equipment, they store the equipment, they put gas in the equipment, they insure the equipment, and all that kind of stuff. And 3-4 guys come out, and it only takes them an hour. Sweet. I don't have to store the equipment, buy the equipment, maintain the equipment, insure the equipment. I don't have to do any of that. My time is too valuable for me to do that, so I just pay them. Okay? So my money goes away. I'm financially weakened. Okay? That's how that looks. Cool. So I think we did enough today. We didn't do a lot of technical analysis, but we did some, and then I answered some pretty big questions. And then you also learned, how does politics impact finance? You learned how a new, potentially new for you, way to measure economic activity around the world using Baltic Dry Index, so on and so forth. I hope you found it educational, fun, and entertaining. If you could, please leave a comment on today's video and tell me what you learned. I do read your comments. I do. Would you also do the thumbs up on today's video? And if you are new, would you please consider joining our community by subscribing? I do these webinars every single day. So I will see you tomorrow. And I guess just... Oops, that's not right. How do we go? Where did it go? I guess we're here, full webcam. There we go. So peace on earth. May the pips be with you. May our profits be above average. You have a great day, huh?